Right now, Indranil Sengupta, economist and head of research at CLSA India, joining in on the show right now. Indranil, great to have you on the show. Just wanted to understand whether you're also working with an assumption that it's going to be a status quo once again and an accommodative stance from the RBI this time too.
Yes, I am, with two qualifications. Number one, I think the RBI will look to continue to suck out liquidity. And so they will probably introduce more and more measures, to suck out the surplus money market liquidity that we have. At some stage, I think the RBI will also highlight that, the rate cycle could be turning with the Fed scheduled now to hike in, let's say, 6-7 months' time. But overall, I think, especially given that demand clearly is very weak in India still, I think they will remain on the status quo.
Sure. Just on the point that you made, Indranil, right now, given that this is a very important week, you've got commentary expected from the Fed as well, and commentary around the taper is pretty much par for the course. Wanted to understand whether money markets have already absorbed this possible change of stance from the RBI in light of what we've already heard from the Fed.
I would not think so. I think, the money markets are still, I think, maybe the markets are aware that the RBI has to start hiking, but I would not say that bond yields have priced in RBI rate hikes. So we are looking at 100 basis points of rate hikes in FY22, 23, FY23. And I don't think that is in the price as far as government bond yields are concerned.
Good morning. So now with the kind of commentary that we have seen in the run-up to the monetary policy from the Fed chair, whether the inflation is transient or structural, we don't know what's going to happen in the December 16th meet of the US Fed as well. And I know Aisha tried to address this with you. So basically, could that also be a reason for a status quo type of policy, simply because you want to see how the other central banks will be reacting?
Yes, of course. I think, your economy still remains weak. B, you have this whole Omicron uncertainty. C, you want to wait and see what the Fed does. And, it's just not the Fed. Clearly, the PBOC cut the RRR last night. So growth is not a given anywhere in the world right now. So from that perspective, I think the RBI will wait and watch, especially with oil prices lower. So to some extent, your inflation risks, to the extent they ever existed, are low.
But the problem is that unlike the United States, in India, we of course have a higher interest rate regime, right? And with what's happening with the dollar index, these are the problems that the RBI Monetary Policy Committee will have to tackle, with inflation on one point, but a capex cycle which is making a comeback, and with a keen eye on the currency.
Well, let me break that down into 2-3 parts. Number one, I think the currency is reasonably well protected by FX reserves. So I don't think monetary policy has to worry about the currency. I think that if the dollar strengthens, the RBI will, let the rupee weaken a bit, because you don't want to waste precious FX reserves when you know that you are now a price maker in FX markets, like you were, 15 years ago. So why would you spend FX on temporary dollar movements? So I don't think that, the currency is a part of this, number one. When you look at the interest rates vis-a-vis the US, obviously in India, growth and inflation are, higher than that of the US. So interest rates are bound to be higher than the US. And I think that it is the wisdom of, the RBI governor and the MPC that they have kept a buffers, ammunition in case, things go wrong globally. Now you have not only a buffer in terms of FX reserves, but you also have the ability to cut rates if necessary, which, none of the G3 central banks have. So I think that is actually a good thing to have. So I think the driving concern will be to see, a sustainable recovery. And, so the RBI will hold its hand for now. But then, once you get some visibility there, you cannot also continue with negative policy rates for too long.
Okay. Indranil, just coming in on the RBI's liquidity management. Of course, since the last policy, you've seen just a step in the direction of pulling back on liquidity. How do you see that panning out? And what do you anticipate will be the move and the approach by the RBI in the context of what we are seeing right now?
So I think, the large pool of liquidity that we have is by far our risk number one. Because, let me explain why. You have a high fiscal deficit, which clearly needs RBI OM. And if you have a high pool of liquidity, almost 2 years of, durable liquidity sloshing around in money markets, clearly you will not be able to support the bond market. So paradoxically, high domestic liquidity will push up yields. So I think it's very, very important that the RBI takes all possible measures to pull back domestic liquidity, which they are doing. You saw, the increase in HTM last year. You've seen the CRR hike this year. You've seen the introduction of, longer and longer term repos. They could introduce 2-3 year reverse repos. I'm sorry, longer and longer reverse repos. I am very much in favor of introducing 2-3 year reverse repos so that you lock up this liquidity and continue to support, the high fiscal deficit, as was the case in pre-COVID levels. Otherwise, what will happen is that, at some stage, yields will start to shoot up because the bond market will estimate that with given so much of high money market liquidity, the RBI will not be able to OMO at some point in time.
Understood. And you've explained that paradox very well, I think. Indranil, just another point on inflation. There are murmurs and in fact a statement that perhaps the transitory tag needs to be retired in another market entirely. Here we've seen core inflation that has remained sticky, but you've had the headline well within the comfort level of the RBI. What is your own expectation on inflation? You've had CE also talk about the fact that food is a major contributor and that seems to be settling down. How do you anticipate that this will move?
So let me say that, there are short-term movements and there are long-term movements. So long-term, I think this year and next year, we are looking at inflation around 5.5%. As you know, the RBI has also, re-estimated, so the long-term estimate earlier that the growth maximizing threshold inflation of the economy is 5.5%. So, from that perspective, I think inflation is not a worry. Now, turning to inflation and core inflation, base effects have pulled down food price inflation for now. And as we, as those go away, you will see food inflation making a comeback, in the first quarter of next year. At the same time, because oil prices are rolling over, LPG prices, the base will come into the base, core inflation will come down. So there are, there is a long-term story, but the immediate story is that yes, inflation can go up and will go up in the next quarter. I think even the RBI says that because these base effects that have brought down food inflation will go away, but core inflation will come down because right now the biggest driver of core inflation, I think, or at least one of the biggest drivers is this, steep increase in LPG prices, etc., etc. Those will all get into the base because, they started happening by the end of last year or early this year.
Absolutely. Absolutely. Thank you so much, Indranil, for taking the time, for setting the context, and I'm sure we'll hear from the RBI governor soon enough about all of the points that you just mentioned. All right, on that note, we're slipping into a